Hi, everybody. January 14th, the market update desk with Scott Riley. We're back in the studio now. The knee's feeling a little better. I'm about 3 months out from knee surgery. So starting to get things back in order, coming to the office now. So we had some positive news come out today, a little bit unexpected. So the PPI, Producer Price Index, which measures wholesale inflation, rose 0.2% in December, which was half of what the market expected at plus 0.4. Year over year did increase from 3% to 3.3%, but that's really because of the negative replacement number from last year. We actually had a negative number last year for PPI that we replaced with this year's numbers. So really, it's a very healthy report for the bond market. The core rate, which strips out the volatile food and energy, was actually flat this month. It was zero. Now, this was much better again than the market anticipated at plus 0.2%. Now, we did have a revision from the previous month, which brought year over year PPI from 3.4 to 3.5. But because of the zero that we got in core, we stayed at 3.5%, which was, again, better than what the market expected, even including that negative revision. Now, almost exclusively, the inflationary cost came from goods prices. Those rose 0.6, largely due to the 10% increase in gasoline, which we've been talking about via oil. The services sector, which has really been kind of a challenge for inflation, gave us a zero. So no increase in the services sector of wholesale inflation. So that did help keep prices at bay. Now, interestingly, last month we had fruit and vegetables rose 33%, huge number. This month, we actually saw it fell 15%. So we started to get some more inline numbers there. Now, what is a positive thing, again, out of this report is later this month, we get the PCE, Personal Consumption Expenditure, which is January 31st. Now, this shares a lot of the same data and components as the PPI report. So this could be a nice foreboding of some helpful things for the bond market. Now, we also got today the New York Fed's Consumer Expectation Survey. Yesterday, we talked about consumer sentiment. Now we're going to talk about the New York Fed's Consumer Survey. Now, what they showed was the mean perceived probability of finding a job if one's current job was lost declined by 50.2% from 54.1%. That's a huge decline from 54 to 50%. In fact, this is the lowest reading for being able to find a job in consumer expectations since April of 21. And obviously, we know what was going on in 21. Now, we also saw in today's Wall Street Journal, they posted an article, very, very interesting reading, that was entitled, Fake Job Postings Are Becoming a Real Problem, specifically regarding the JOLTS report. Within the article explained that 22% of the jobs advertised are fake or not filled and called ghost jobs. Ghost jobs are roles that companies advertise but have no intention of filling and are often done to suggest growth, keep postings up for exceptional candidates, or comply with federal law. Add to that the multiple counting of job postings in multiple states due to remote jobs, and one can conclude job openings in the JOLTS report are likely highly overstated. Very important article there. Now, the National Federation of Independent Business Small Business Optimism Index. This got a nice little bump today. So the NFIB Small Business Optimism Index for December rose from 105.1 to 101.7. In fact, that's the highest level since October of 2018. The NFIB chief economist, Bill Duncanberg, said, and I quote, small business owners feel more certain and hopeful about the economic agenda of the new administration, expectations for economic growth, lower inflation, and positive business conditions have increased in anticipation of pro-business policies and legislative activity in the new year, unquote. Very important thing because small businesses have been the one taking it in the teeth the last 6 to 8 months. On a technical analysis, we're kind of flat today. 10-year bond is flat, 476. Mortgage-backed securities are slightly better, 5 basis points. We are hitting a light resistance level on mortgage-backed securities. Now, traders aren't going to be likely to push one way or the other today because we do get CPI tomorrow. So the fact that we've arrested some of our decline in mortgage-backed securities and uptick in 10-year bond is a positive thing. Now, the fact that we got better than expected inflation in the PPI does bode well for tomorrow, and we were hopeful of that. In fact, the part that could really make a difference is shelter costs within CPI. If we get a little bit of a benefit within shelter costs, which at some point we've talked about these lag effects of shelter, that could bode well for tomorrow, and that means bode well for the mortgage market. Thanks for watching. We appreciate it. Watch, share, like if you could. We're on Facebook, Instagram, and YouTube. The Market Update Desk. We appreciate you. 616-293-2189 is our number to help get you pre-approved and help you with your mortgage needs. Have a great afternoon.